in today's lesson, we are going to be practicing how to do the final accounts with accruals and prepayments by doing the solutions to two of our workbook exercises or activities, 6.11 and 6.12. So we are required to prepare both the full income statement and balance sheet this time, including the adjusting entries, accruals, and prepayments. The income statement has two sections. The first is the trading account section, where you are required to memorize the format to calculate net sales, cost of sales, and gross profit. The second section is the profit and loss section, where you record your revenue and expenses, and the net profit is calculated. It is in the profit and loss section that the expenses and revenue are adjusted by adding accruals or subtracting prepayments. So to the expense paid and the revenue received in the trial balance, we add accruals and less prepayments. After we have completed the income statement, we prepare the balance sheet that also has two sections that calculate two totals. Remember, the two totals must be equal for the balance sheet to balance. In the balance sheet, we start with the non-current assets and then proceed to the current assets and current liabilities, which is where we record our accruals and prepayments when they are identified in the notes or additional information. Prepaid expenses and accrued revenue are recorded under current assets, while accrued expenses and prepaid or unearned revenue are current liabilities. So in summary, this is what is required for final accounts with accruals and prepayments. For the income statement, focus on AA and less P in the profit and loss section. AA being add accruals and less P being less prepayments. For the balance sheet, focus on identifying and recording the relevant accruals and prepayments under current assets and current liabilities. So let's now go into our activities. Okay, so we're going to go into our two activities. And the first one that we are going to do, of course, would be 6.11. And based on what we said before, the first thing that you're going to have to prepare would be the income statement. The income statement, as we said before, is made up of the two parts, which would be the trading section and the profit and loss section. And just a reminder, it's a profit and loss section that we deal with the accruals and prepayments, where we add the accrual and we less the prepayment. So that is the first thing that we're going to go into. And trading section, this is the very, very, very long format that you have to practice, that we had practiced before. This is what you need to memorize because it is a format in a certain order. Once you have this done, everything else is easy sailing. So starting with our activity 6.11, the first thing that you do for any format is you put the name of the business, and the name of the business in this case is J. James. So you put the name of the business, and then what are we doing? We're doing an income statement for the year ended, and what is the period? As we see up here highlighted, this gives you the name and the date, and it's the 31st of December 2017. We have three columns, dollar columns as I call them. So you would put your dollar signs there to represent that. The column here, the large one, is for your details. And the first thing that you start with for your income statement is always your sales revenue. And your sales revenue is your main revenue. So your sales revenue, where would you find that? You look into your trial balance and you're looking for sales down the list, and you would see your sales here. So now that you found your sales, How much is your sales? It is 11,680. So we're going to put it in the last column. That is where we always put our sales. That is what you would have practiced. So we're just going to move ahead. What is the next thing in your format? Sales returns, less sales returns, or return inwards. So your sales returns, you look into your trial balance, and right under sales you see that we have it as sales returns. How much is it? 300. So you just plug it in, and remember to always put your brackets. Brackets signify in your accounting language that you are going to subtract something. So you're going to minus something. That's the first two things, and it's the only two things in the first part of your income statement. So it's very, very easy. Sales less sales returns. And that is the first calculation that you would do. And 11,680 less the 300 will give you your net sales of 11,380. So now that you have finished that first very, very, very easy section, you're going to go into the cost of sales, less cost of sales. Now, if you remember, gross profit is your sales less your cost of sales. In some questions, they would give you the cost of sales figure and you just simply minus it from your net sales. But in this case, they did not give you that figure. We have to calculate it. And this is the longest part of the whole entire income statement. This is the part that you have to memorize and practice so that it's easy sailing after this. So what is the very, very first thing that you start with for your cost of sales? What stock do you start with at the beginning of the period? It is your opening stock. Your opening stock or opening inventory is how much you have at the beginning of a period. That's what you start off the period with. Where do you find that? In your trial balance. So you're going to look down your trial balance and you would see inventory. This inventory in your trial balance is your opening inventory. We will see further on that your closing inventory is not in your trial balance but down in your notes. But in your trial balance, this inventory that we see here is your opening inventory. We are going to put that in the middle column because we have some calculations to do before we can go over to the final or the last column. That is reserved for your cost of sales figure when we calculate it. So your opening inventory goes in your middle column, and the next thing is to add your purchases. Now, which column would your purchases go in when you find it? So you can see, you go in your trial balance and you see that we have our purchases there. We have already found our purchases. Which column are we going to put the $3,704 in? That depends on whether we have any adjustments to do to purchases. What adjustments do we usually have to do? 2 adjustments to purchases, which would be, are there any returns outwards, also known as purchases returns, and carriage inwards? So you have to go into your trial balance and look to see if you have any of those things, those 2 things that would adjust the purchases figure. And you would see that yes, we do. We have a purchases return of $200 and we have a carriage inwards of $150. So basically, that means that your purchases has some adjustment to be done. So it cannot be added to opening inventory as yet. So because of that, we cannot place it in this middle column yet because we have to do some calculations, make some adjustments to that figure. So because of that, we are going to place our purchases figure in the first column. So the 3,704 you see goes in the first column, and then we will make our adjustments. And the first adjustment we're going to make is we're going to less purchases returns. So we're lessing purchases returns from purchases. because you have returned those goods. They no longer belong in purchases. You don't have that stock anymore. Purchases would be the stock that you had purchased. Purchases returns would be that you have returned those purchases for whatever reason, whether it was damaged or wrong order or whatever it is. So you have to subtract it from your purchases figure. So how much was your purchases returns? You would see here it was 200. So you're going to put it underneath in the first column, and the brackets signify that you're going to minus it or subtract it. So we basically will do a just a simple calculation. This figure is nothing as yet. We just have it there as we just calculated. We showed the 3,504 from minusing your purchases. And then the next one that we have to adjust purchases with would be your carriage inwards. That is the transportation in. So when you had ordered or purchased your stock, you may have had to pay for delivery or for transportation in, delivery in, right? So that is added to your cost of the purchases, right? So it increases the cost of your purchases, so you have to add it to your purchases, and that means that you add the 150. Do your calculation there, and the figure that you get is called your net purchases. Net meaning that you have made your adjustments to your original purchases figure, and now you have a net figure, just like you had net sales above. So just like you had the net sales above, you now have your net purchases because of the adjustment done to it. And this figure goes right in the middle column to be added to your opening inventory. Right, so this figure, the net purchases that you get, which is the purchases after the adjustments, that is the figure that gets to go into your middle column. So it goes into your middle column there. So opening inventory, add your net purchases, gives you what is called your cost of goods available for sale. See that? So very, very long term. It is the cost of the goods that you can now sell. Because you had opening inventory, you purchased inventory, you now have a net purchases figure. So this total amount, which is your opening inventory, add your net purchases, gives you the cost of all the goods that are now available for you to sell. And that figure is the 6,324, which is this figure right here. So we would have gone through this part here, which is kind of your little adjustment for the purchases. Otherwise, cost of sales would have just simply have been opening inventory, add purchases, less closing stock. But because we had to do this with your purchases, which are the two items here, the purchases returns and the carriage inwards, we have this little section here that you had to get out of the way, calculate, and then you have it on this side here. So what we just did there is your opening inventory, add your net purchases is equal to your cost of goods available for sale. That is what we have accomplished. So we move on to the next step, which would be you now have to less your closing inventory, and that is the final step for you to be able to get your cost of sales. So after you have that long word, cost of goods available for sale, don't think you have finished, which a lot of people think they have. You still have one more thing to do, which is to less your closing inventory. And where do you find your closing inventory? In your notes. So down below here, you see where this animated man is looking. And right in your notes there, closing inventory. See down below here, highlighted for you, that is your closing stock. So your closing stock is 1,750. So you're going to put that here, right underneath your cost of goods available for sale. Once again, the brackets signify that you have to subtract it. So you're going to subtract it. See, less closing inventory, less closing inventory. And the answer that you're going to get is called your cost of sales, which is what we have been calculating. That is the end figure. And that is the figure that goes into your final column. So your net sales less your cost of sales, which is what we have to do now. Your net sales less your cost of sales. That is what is going to give you your gross profit. And the 11,380 less your 4,574 gives you your figure or your gross profit of 6,806. So that's it. We have just completed our gross profit, our first section, the trading section, trading meaning to buy and sell. So we have just finished that part of it, and that is the part that calculates your gross profit, and we got the 6,806. So after we have done the first part, which is the trading section, you would see that we now have to go and do the second part, which is known as your profit and loss section. This is where we have our revenue and our expenses, and this is where we deal with our accruals and prepayments. So you would see here over on our trial balance, kind of blocked out all of the things that we have already used. So these are where we are going to be looking for our revenue. But before we do that, let's just bring our gross profit. Our gross profit is what we ended with before, and we would just continue on the page, but because of space, have it separately. So just brought our gross profit down, and remember we had a gross profit of 6,806. And what we do next, what is the next step? You add revenue. So what you do to know you add revenue, you have to go to your trial balance over on this side, and you have to look for any revenue that you may find there. So is bank revenue? No. Accounts receivable? No. Insurance, land, accounts payable, mortgage, capital? No. Repair revenue. Now, how you can also know that it's revenue is revenue is supposed to be on the credit column, right? Revenue is called credit. If you remember with Alice, debit, credit, 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 debit. So assets and expenses are debits, and the other three are credits, which include revenue. So you see repair revenue, $20. So we have our revenue there. Do we just go across and put it in the income statement? No, we don't, because remember, we have accruals and prepayments. Because of the accrual or the matching concept, we cannot just put the 20, which represents the amount of revenue received. Reminder, we have to put the revenue earned. And revenue earned would be the revenue received, add the accruals, less the prepayments. Where would we find those adjustments? Reminder once again, you should know by now, you look down in your notes. So because we may have an adjustment to be done, an accrual or a prepayment, we look down in our notes, we look for repair revenue, and you would see that we do have an adjustment outstanding. What is outstanding? An accrual. So we have an accrued revenue. What do you do with accruals? You add them. So you will go to your income statement, repair revenue, and it is 20, which is the amount in your trial balance, plus or add your accrual, which is 130. So 20 plus 130 gives you 150. So we put the 150 in the column, and since there are no more revenue, we are just going to add that to your gross profit, and we have a total revenue of 6,956. Right? So you see there, We finished that first part. It was very, very, very simple because we only had one revenue. But once you can identify the revenue, very, very easy. Right? So we're just going to move on quickly. After you have your total revenue figure, you're going to less any expenses. So you go to your trial balance again and you're looking for expenses. And you see here, insurance. Insurance is an expense. So once again, you're going to go down in your notes because of the accruals and prepayments. We may have accruals and prepayments. So you go down in your notes and you're looking for anything to do with insurance, and you would see note number 6, insurance. That means that you have a prepayment. Paid in advance is a prepayment. And what do you do with prepayments? You less it. So you're going to go to your income statement. Under insurance, you're going to put, under expenses, you're going to put insurance. You must show you're working. So your working is how much is in the trial balance? $2,400. Less the prepayment. How much is the prepayment? $2,400. So $2,400 minus $2,400 is 0. So we put that in the middle column. Now the reason why I put it even though it is 0 is because we still want to show how we got that there was no insurance. So still put it. Even though you know the answer is 0, put it, show you're working, and you can just put either a dash or you can put 0 in the middle column. Okay, so we go down again and we're looking for any expenses. And we have advertising. So we have advertising. We look down in our notes for anything to do with advertising and not seeing anything to do with advertising. Don't ignore it. It is an expense, so it still goes into the income statement. So you go under expenses, you put advertising. Since there are no adjustments to be done, meaning no accruals or prepayments, you just put exactly the amount that is in your trial balance, which is $200, and you move on. Okay, bank charges, also an expense. You go down to your notes, you look for anything to do with bank charges. You see nothing, so you still go to your income statement, you put bank charges, no adjustments, so you just put what is in the trial balance, which is $50. Electricity, an expense. Go down to your notes. Are you seeing anything with electricity? Yes. So you see that electricity paid in advance. Paid in advance is a prepayment. So as a prepayment, you less it. You go into your income statement, you put electricity, show you're working, $490 from the trial balance, less your prepayment from the notes, which is $40, and that gives you $450. Rent is an expense. You go down in your notes and you look for anything to do with rent. Rent incurred for the year. This note number 4, is not giving you the accrual or the prepayment. This one actually gave you the amount that goes into the income statement. Because remember, what goes into the income statement? The expense incurred. So once you see rent incurred, it means that is the figure that is going to go into your income statement. So you're simply going to go income statement. You're going to put rent. I just put the little note there for you, a little asterisk. You can do that if you want to from the notes or anything, or you just leave it blank because there is no working to be done. But I'm just showing you that we got our figure from the notes and the amount is the $2,400, right? The amount incurred. All the others, like the electricity here, the $490 minus the $40, the $450 is the incurred figure. but we just had to calculate it. It's just for rent. They gave it to us. So you just put it in, right? Next one is wages. Wages is an expense. You look down below in your notes. There is wages. Wages owing. Owing means accrual. You add accruals. So you go into your income statement, wages, you put the amount from the trial balance of $3,540 plus your accrual of $160, and the answer you get $3,700. And you look and you see that you have gotten all of your expenses. Yes, we got them all. And then you even look that you saw that you accounted for all of your adjustments, right? So you've done everything. You can now calculate what your total expenses are. You add up those figures and the answer you get will be $6,800. Note the brackets. That is to signify that you're going to less the expenses. You're going to subtract. What are you subtracting from? Your total revenue figure here. So you have this minus that, and that is going to give you your final figure, your net profit. And your net profit, where you have the $6,956 less your $6,800, gives you $156. And since that's the end, you have your double line, and that is your income statement. Right? So that's your answer there for the second part of your income statement, which is the profit and loss section. Net profit 156. So for 6.11 J. James, you have your first part there, which is the part that you have to memorize and practice and practice and practice. Once you get through that, that calculates your gross profit. And then you have your second part, which would be your profit and loss section, and that calculates your final one, which would be your net profit, your final figure, net profit. And that is the section that we deal with the revenue, expenses, and therefore the accruals and prepayments. Always put your working. Check your trial balance, identify your revenue and expenses, check your notes for each one, see if there's an accrual or prepayment. If there is an accrual, you add it to the amount in the trial balance. If there's a prepayment, you less from the amount in the trial balance. Simple as that. Put your working, go one by one. You can always cross out, check off or whatever, just to make sure you got everything. And then you get your final figure. And you're finished and collect your marks. Yeah? Cool. Pat yourself on your back. And this is what it would look like in your answer sheet. You will see it's not broken up. You have your first part here with the gross profit, and then you just continue on to the profit and loss section. So this is how your answer would look for an answer sheet. We have done that, and now we're going to move on to the balance sheet, where the prepaid expense and accrued revenue are your current assets, and your accrued expense and prepaid revenue would be your current liabilities. So that is what we're going to concentrate there on now. But before we actually go into do the balance sheet, my suggestion is to look at your notes and make a few little notes of your own in terms of what would be the current assets and the current liabilities. Now, you can always start your format with your non-current assets and then go and do this. But I am just going to do it first, and then we are going to start the balance sheet, right? So I'm going to show you the process. So the notes usually tell you the adjustments or the accruals and prepayments. And therefore, when you identify the accrual or prepayment, then you would know whether it's a current asset or it's a current liability. So I'm going to show you exactly what I mean, the process again. But the first thing is, well, in our notes we had stock, and remember the stock is your closing inventory or your closing stock, right? So we had dealt with that already in the income statement, but it is to note that your closing inventory also goes in your balance sheet under current assets. So we just have a little note there of that. But we are going to go on to the actual adjustments now. So our first adjustment would be repair revenue outstanding. Outstanding means accrual, and it is revenue. So this is an accrued revenue. And what is an accrued revenue? If you remember, an accrued revenue is a current asset. So you see little note here. This is what I meant by just placing these little notes very, very briefly. You can do it in shorthand or whatever. You could just put CA, right? But once you have this in the exam, you can just go and plug it in afterwards, So this is just a process that you can do where you put the notes first and then you go and so you do all your thinking first and you just jot it down, and then you just go and you just plug it into the format. So the first one, we have a current asset. Your next adjustment is electricity paid in advance. Paid in advance is a prepayment. Electricity is an expense. So that is a prepaid expense. And what a prepaid expense is? Current asset. See how simple? Very, very, very easy. Rent incurred for the year. This one, once again, is unique. It did not give you the accrual or prepayment. This actually gave you the incurred amount which went into our income statement. So to find out what the accrual or prepayment is, we didn't have to do calculations for the income statement, but we have to now do the calculations for the balance sheet. So we're going to need to now look back at our trial balance and find rent. And we see that we have rent here. And what is the amount paid? $22.40, so $2,240, because remember, the amounts in the trial balance represent the amount paid for expenses. So if the amount paid was $2,240, yet our notes tell us that the amount incurred was $2,400, that means that we actually ended up paying less than was incurred. And when you pay less, it means you are still owing, which is an accrual. So what we have there is an accrual, an accrued expense. How do we know it's an expense? Because it was incurred. So incurred is for expenses. So it's accrued expense. And to find out how much is still owing, it will be the amount incurred minus the amount paid, which is in your trial balance. So the $2,400 minus the $2,240, and that will give you your accrued expense, and the accrued expense is a current liability because it is still owing. Okay, so I hope that one was clear. So in some cases, most cases, you just go into the notes. But in some cases, like in this one, you would have to go back into the trial balance to compare the amount incurred with the amount paid. And then you will know whether it's an accrual or a prepayment. If you paid less, it's an accrual because you're still owing. If you paid more, that means you paid in advance, which is a prepayment. So in this case, you paid less, it's an accrual. Okay? Right. So we could black out that again because we have dealt with that. We go on to the next one, which is wages owing. They've told us owing means an accrual. Wages is an expense, so it's an accrued expense. An accrued expense, very easy, is a current liability. And the last one, insurance paid in advance. Paid in advance is a prepayment. Insurance is an expense. So you have a prepaid expense, and a prepaid expense is a current asset. Right, so we have our notes here, and from our notes, what we would realize is that we have 3 current assets. We saw that change into green, so we will have that represent our current assets. And we have 2 current liabilities in terms of our accruals and prepayments. Great. So I think that was nice. Once you just go through the process, get a nice little rhythm going there, groove, and you should be good. But you get a groove when you practice, huh? So I really hope that you guys practice and practice. So now we're going to go into our balance sheet, because we did an income statement before. Notice I have my notes here with the little notes that we had jotted down. Once again, with any format, you put the name of the business, J. James, and in this case, we're doing a balance sheet, and the title is Balance Sheet as At, and the date is the 31st of December 2017. Just like the income statement, you have your $3 columns. And in this case, we start, before we go into current assets and current liabilities, we start with non-current assets, which used to be called fixed assets. So if you are doing any past papers from a while ago and you see fixed assets, it's the same as non-current assets. So your non-current assets, you would look into your trial balance, not land. Land is the most fixed asset, right? So you always start with land, because in CSEC we do it in the order of permanence. So it's the most permanent. So you start with land. So you see land. So you go under, you put land. Land at cost just means it's the original amount, and that is the amount that goes into your balance sheet. So land, and it's 20,000, and we put it into the last column. That's it. So we've done land. If you look, you would see that there are no other non-current assets. So we just move on. And the next thing, we go to our current assets. And the current assets, there is an order. You always start with your inventory, and it is your closing inventory, not your opening. It is always your closing inventory. And where do you find your closing inventory? In the notes, right? So your closing inventory, and we will put that in the middle column. Your closing inventory is 1,750. So that you put, and that's it. You move on to the next one in order. Accounts receivable, also known as debtors. So you look into your trial balance, and you will find your accounts receivable there. You just plug in a figure right underneath your inventory, 4,806. That's it. Next, and this is the new part for your balance sheet, as we had learned, it is prepaid expense, accrued revenue, in any order once, but it comes after the accounts receivable. Where will we find that? In our notes. And remember, we had done our little notes to our notes. So we will go down and we will look at our notes here. And since we are under current assets, we're looking at the green areas. We have 1, 2, and 3. So we're just going to put it in any order. We have the first one is the repair revenue, so the accrued revenue. Let's deal with the accrued revenue first. Accrued, but notice you're not just going to put revenue, you have to put the specific revenue. In this case, it's repair revenue. So you're going to put accrued repair revenue. And how much is your accrued repair revenue? $130. Easy. Okay, the next one, your next current assets, you have a prepaid expense. So you write prepaid, and what is the expense? Electricity. And how much is it? $40. You just put it there. That's it. What is the next current asset? It is not the number 4, number 5, number 6. So you have a prepaid expense. What is the expense? Insurance. So you put prepaid insurance. How much is the prepayment? $2,400, and that's it. So you see our three accruals and prepayments. So we have an accrual, an accrued revenue, which is a current asset, and two prepaid expenses. Very specific. Do not ever total them, and you just have them separately, and that is it. You have dealt with all your green, all your current assets, so you can now move on. So what we had learned before, it's inventory, accounts receivable. We stick this in the middle. Next one would be bank, and then cash. So we're going to look and see, is there any bank? And we see in our trial balance, we have bank of 41,150. Just simply put it in the column. That's it. And then we're going to look for, is there any cash? No, there is no cash. So that is it for your current assets. Now, if you have been highlighting, ticking off whatever it is, you would see, or you can always just check, you see you have three more things left out, and none of them are current assets, which means that we are finished with our current assets, right? So we can just total it now, and your total current assets, when you add up all those things, would be 50,276. So you move on. What's the next step? To work out your working capital, you less your current liabilities. So we're going on to the next part of it, which would be liabilities now. You less current liabilities. And which is the first one you usually start with? It could be a bank loan that is less than a year. We look and we don't see any bank loans that they say is less than a year. And then there's the accounts payable. So accounts payable, they usually have accounts payable, also known as creditor. And you would see that it is 1,800. Which column do we put it in? Because we have some other current liabilities, as we saw from our notes, we cannot put it in the middle column as yet because we have some calculations to do. So we would put it over to the side, the first column, so that everything doesn't get all confusing with or a long line of numbers. So you just kind of put it off to the side here, and you would put your 1,800 over to the side there, right? So we go to our notes, and we see that we have two current liabilities highlighted there in orange for you to see. And we will start with the first one, which would be the accrued expense. So which is the expense? It's rent. So you put accrued rent. Since we had to do some working for that one, we can put the working here just to show how we got to our figure. And the working was the 2,400, which was incurred, less the 2,240, which was the amount in the trial balance that represents the amount that was paid. And therefore, you still have owing of $160. And you just put it in that column there underneath your accounts payable. Good? And then we have another one, which would be wages owing, accrued expense, which would be accrued wages. And they gave us the amount. How much was owing? 160. So you just put it there. Now, another current liability could be bank overdraft, but you see that we have bank account already, and you see there's no other current liability. So which means we can just total it, and your total figure you get to put now, after you have put this over here for neatness, it's all neat and clear. Your total, you can now put it in this column to be subtracted from your current liabilities, because what you see, it is current assets less current liabilities, and that gives you what we call our working capital. So it will be your current assets of 50,276 less your current liabilities of 2,120, and that gives you your working capital, which gets to go in this column, the last column, and your working capital is 48,156, and it's a positive figure. Notice you don't put any brackets or anything like that. Whatever you get, you put. If it's a positive figure, you put it as a positive figure. If it happened to be a negative figure, then you would put it across with your brackets. In this case, it's a positive figure, 48,156. You put it across in the last column and you add it to your fixed or your non-current assets of 20,000, and that gives you your first total. Your first total, because it's broken up, remember, into the two. So your first total, 68,156. And that's it for the first part, and that's the accrual and prepayment part of it. Okay? So there we have it. Current assets, current liabilities is the new section, and the section that deals with accruals and prepayments. These were the accruals and prepayments in green and in orange, but that's as simple as that. Okay, so we just move on to the next part. The second part would be your financed by. And if you look over here at our trial balance, you would see we only have two more things left. Right, we have basically dealt with everything. So your finance by, the first thing you start with would be your opening capital, and your opening capital is the amount in your trial balance over here. So your opening capital is 50,000. You can use any column, whether it's the middle column or the last column, because it eventually has to go into the last column. I prefer to use the middle column just to keep from having a whole set of numbers in the last column. Okay, so we have opening capital 50,000. You add your net profit. Now, where do we get our net profit from? Remember, we worked out our net profit in the income statement. So our net profit for J. James was the $156. Yeah, he made a little profit, right? That is how much we had actually worked out, $156. So that is the amount that will go into your balance sheet, right? 156. So you add that to your opening capital and you get 50,156. Now you have one other thing that you usually do, which is the less drawings. Drawings is a decrease in capital, so you have to less it if there were any drawings. When you look here, you see there are no drawings. So you can either put 0 or you can put a dash, whatever it is. If you're just doing the format as you learned it, you're not going to lose marks if you put in drawings. You're not going to lose marks if you don't put any drawings, because there are none. Okay? So that means that your closing capital is $50,156. So you finish that very easy part, and then the last thing that you do is you have not dealt with your long-term or your non-current liabilities, because if you look at your trial balance, you would see that we still have something unrecorded, which is mortgage, and that would fall under your non-current liabilities. So you put your mortgage and it's 18,000. Since it's only one, you can put it into your last column one time, and your closing capital plus your mortgage would give you your second total, which is 68,156. Now, if you notice, thankfully, our totals are equal, which is exactly what is supposed to happen. Right? If it doesn't happen, you have to go and recheck. You might have done something wrong. You may have omitted something. But once those totals are equal, that means your balance sheet has balanced and you can celebrate. So once again, this would be our balance sheet, where you had the long first part of it to get that first total. You had your non-current assets, and then you had, for the accruals and prepayments, the most important part, That section is the most important part, the current assets and the current liabilities, because that is where you would place your accruals and prepayments. So once you do that, you work out your working capital, you get your first total. Then the second part is extremely easy. With your opening capital, add your net profit from your income statement, less your drawings, if any, and then add any non-current liabilities. Hopefully, both totals equal. So the two totals were equal and therefore it balanced and you're good to go. So for 6.1, these are your answers for both of your final accounts. It's just one continuous thing, but you can just break it up into parts for your mind and focus on the first part and then continue to the next part, so that it doesn't get all confuffled in your brain. Focus on one thing at a time. For income statement, first part, sales less sales returns equal net sales. That's all you think about. Get that done. Then you move on to the second part. Start with your opening inventory and go through. And once you keep on practicing and practicing, it becomes easier for you. Now that we have done 6.11, we are going to be doing 6.12. We're going to do it a bit quicker. And it's the same thing that is needed. You have to do your income statement and you have to do your balance sheet. Okay, so we're just going to go straight into it. And once again, you start with your trading section. Put the name of the business, and in this case, it's R. Ram Logan. We are doing an income statement. So income statement for the year ended, and in this case, the date is the 30th of April 2017. You have your $3 columns. Start with sales, going to your trial balance, look for sales. You have 57,770. You put it in the last column. That's it. You move on. What's the next part? Less sales returns or returns inwards. You look for it in your trial balance. You see return inwards 3,500. You put it into the last column, brackets to signify that you're going to less it. Then you're just going to do the calculations. That gives you your net sales, which would be 54,270. Finish the first part. Move on. Less cost of sales. Once they have not given you the figure, that means that you have to calculate it. This is a heading. We now have to go and do some calculations. And for our calculations, the first thing you start with, opening inventory. Where do you find your opening inventory? In your trial balance. So your opening inventory, 10,700, middle column. Next thing that you do, add purchases. When you add your purchases may have some adjustments to be done, so you would check to make sure that it doesn't have like returns outwards and carriage inwards. So you have your purchases 20,000, but you also have return outwards and carriage inwards. So which means that your purchases of 20,000, we're going to put it in the first column so that we can do those calculations. Less your returns outwards of 2,400, brackets to show that you're going to less it. Then you have your carriage inwards, which you add because it increases the cost of your purchases. Carriage inwards is 200, so 17,600 plus the 200 will give you a net purchases figure of 17,800, which goes into your middle column to be added to your opening inventory. And your opening inventory, add your net purchases, gives you what is called your cost of goods available for sale, and the 10,700 plus the 17,800 will give you a cost of goods available for sale of 28,500. So you've done that part. You're just going to go on now to the less closing inventory, which is the final part of calculating your cost of sales, and your closing inventory you get in your notes. So it will be that figure down here. Closing inventory 8,540, brackets to signify you're lessing it. And the amount you get is called your cost of sales, which will go into the last column. 28,500 less 8,540 gives you 19,960. And always remember to put your brackets, because remember you are lessing your cost of sales. Right? So you now have your net sales less your cost of sales. That will give you your gross profit. So the 54,270 less the 19,960 gives you a gross profit of $34,310. And that is the first part, your trading section, and you're finished. And once you know your format, you would run through it just as quickly as we just did there, especially if you have your routine of checking and on all that. Okay, so then we do the second part of it, which is your profit and loss section, and we're just going to start with your gross profit, which we calculated above. So we're just going to continue, and what you do is you add revenue. So of course you will go to your trial balance to look for your revenue. A little bit of advice, your revenue will always be the credit. So you could always check down in your credits, basically, if you don't want to check everything here. You have rent received, commissions received, and you have interest received. Those three would be your revenue. So you can either take them one by one, or you can write them all down and then check the notes, but I'm going to take them one by one. So we're going to start with rent received, and you're checking your notes down below, because it's you have to check for accruals and prepayments. You can't just put the 3,600. So you check rent received, anything for rent received. How do we know this is rent received? Because of the earned. Rent earned will obviously be revenue. So you see that we have a note here, but once again, like with the previous activity, in this case, this note did not give you the accrual or prepayment. The fact that it said the rent earned is $2,400 is telling you how much is actually going into the income statement. So we don't have to do any calculations for the income statement. We will have to do calculations to find out which is the accrual or prepayment for the balance sheet. But for now, remember what goes into your income statement: the revenue earned. Since they told you that the amount earned was $2,400, you're going to go under revenue, rent received, and the amount earned, $2,400. Now the reason why I'm putting it in the middle column is because we have three. We've just dealt with the rent received. We had commissions received. Once again, you check your notes. You would see that note number 4, commissions revenue outstanding. Outstanding means it's an accrual. What do you do with accruals? You add it. So you're going to go into income statement, commissions received, put your working. The working would be the amount in your trial balance of $10,097. Since it's an accrual, you would add your accrual of $1,350, and the answer you get, you put that in the middle column, and that is $11,447. You move on to the next one, which would be your interest received. Once again, you check in your notes, not seeing anything for interest received. Still has to go into the income statement, so you put interest received, and since there are no accruals or prepayments, you just put the amount in your trial balance of $230. So you have just done all of your revenue, so you're now going to total it, and the total of the three you put in your last column, and that is $14,077. And then you would add that to your gross profit, and you would have a total revenue of $48,310. $387. So having finished that, you move quickly on to the less expenses. So you go back into the trial balance and you check to see any of these are your expenses, and you will see insurance. So we have insurance. Once again, you go into your notes, see anything with insurance. Yes, you have insurance paid in advance. Paid in advance is a prepayment, so you less prepayments. Go under expenses, put insurance, working the amount in the trial balance of $960 less the prepayment of $200, and the answer goes in the middle column, $760. You check for your next expense, which would be advertising. You look down in the notes and you would see that you have advertising owing $200. Owing is an accrual. So if you have an accrual, you add accruals. So you will go into your income statement, put advertising, and is $158 from your trial balance. Add the accrual of $200, and the answer you get $358. Move on. Your next expense would be printing. You check down in your notes. You look for printing. Anything? No, but you still put it in the income statement. Printing, and you just put the amount from your trial balance of $248. Move on to the next expense, telephone expense. Look down in your notes. So there is an expense incurred of $123. They did not say accrued or prepaid. They gave you the incurred amount. What does that mean? It means that this is the amount that goes into your income statement. So no calculations for this one. So you would put your telephone and the figure that came from your notes, $123, because what goes into the income statement, the expense incurred, just like the revenue earned. Okay, next expense, wages. You check your notes. Yes, you would see that wages outstanding, 1,000 with 1,000. So you will go wages. Outstanding is an accrual. So you add accruals. So it would be the 1,800 from your trial balance, add the 1,000 accrued, and that will give you 2,800. And then your last expense, discount allowed. Check your notes. You would see that we have accounted for all of the notes, so there is nothing for discount allowed. So you just go into your income statement and you just put the $797 from the trial balance. Once you make sure that you have gotten all of your expenses, you're now going to tally or add it up, and your total expenses, you would put it in the last column and put the brackets to signify that you're going to less it, and that is less 5,086. So that from your total revenue would give you your final figure or your net profit. And your net profit in this case is $43,301. So you see, you just go through the process and end up with the answer. Okay, so if you would notice what is left, all of the expenses and the revenue is gone. All we are left with are things for the balance sheet. So for 6.12, this is what your income statement would look like, both sections, where you have your trading section and you have your profit and loss section. Most importantly is your answer of 43,301 as your net profit. Okay, so now that we have done the income statement, we're going to move quickly on to the balance sheet. But just like how I did before, we're going to attack the notes first. So we're going to check and identify the accruals and prepayments that are going to go into the balance sheet under the current assets and the current liabilities. Right? So once again, stock, closing stock is what goes into the balance sheet. Insurance paid in advance, very easy. Paid in advance is prepayment, and insurance is an expense. So we have a prepaid expense. And what is a prepaid expense? It's a current asset. Move on. Rent earned for the year. So they did not tell you the accrual or the prepayment. So we're going to have to go into the trial balance once again. And this time have it shaded in the green. So you have your rent received, and how much was actually received? $3,600. So if 3,600 was received, but the notes told us that the amount earned is actually 2,400. We are comparing those two now. So you received 3,600, but you only earned 2,400. So what exactly does that mean? It means that we received more. And if we received more, that means that we have a prepayment. See how easy? So it's a prepaid revenue because it's rent received and earned. So we have a prepaid revenue. And what is a prepaid revenue? It is a current liability because we have not earned it as yet. So unearned revenue, it's a current liability. And how much have we not earned, or how much is unearned or prepaid? It will be the amount that we received from the trial balance, which is the 3,600, less the amount earned of 2,400. So you see here, and that will give us the 1,200 that we see. So that is how much will go prepaid revenue of 1,200 under current liabilities. So our next note, we have commissions revenue outstanding. Outstanding means accrued. Commissions revenue, that means it is accrued revenue. And what is accrued revenue? A current asset. Easy. This one is easy. Advertising owing, another easy one. Owing is accrued, advertising is an expense. So we have an accrued expense. And what is an accrued expense? It's a current liability. Telephone expense incurred. This note also did not give you the accrual or prepayment. So we're going to have to go into the trial balance and compare the amount that was paid with the amount incurred. And you would see here for telephone, the amount that was paid is $72 compared to the amount that was incurred of $123. So in this case, we paid less than the amount incurred, right? Because 72 is less than 123. And whenever we pay less, that means you're still owing money. So therefore, it's an accrual. And as an accrual, an accrued expense is a current liability. And how much is the accrual? It is the 123 minus the 72, which gives you $51. So that is the amount that is going to go into your balance sheet. And our last note, which would be wages outstanding, you have $1,000 and outstanding is accrued. Wages is an expense, so you have an accrued expense, which is a current liability. So looking at this, we have this time 2 current assets and we have 4 current liabilities. So now we're going to go to our balance sheet. And you're going to start with the name of the business, which is R. Ram Logan. You're going to put that it's a balance sheet. And what is the date? It's as at the 30th of April 2017. You have your $3 columns and you start with your non-current assets. So you look into your trial balance and you look for any non-current assets, and you would see that we have land, which is your most permanent. So you would put land, $35,000. We also had buildings. Buildings is your second in order of permanence, $62,000, last column. And we also had office equipment. So we had office equipment. So we had 3 non-current assets, but in your balance sheet, we have to put it in order of permanence. When you check, you would see that there are no more non-current assets, so you would tally and you have 106,500. So you move on with your current assets. So you always start with your inventory, which is your closing inventory. So you have your closing inventory, which you find down in your notes, and that will be 8,540. Then you move on to your accounts receivable. So you look into your trial balance and you would find your accounts receivable. 5,400 goes underneath your inventory. Then you would have your accruals and prepayment, more specifically your prepaid expense and accrued revenue, which are your current assets. So going down in our notes, highlighted in green, you would see that we have 2. So we don't have to do it in any particular order, but we will do it in the order of the notes. So you have a prepaid expense, which would be your prepaid insurance. And your prepaid insurance is 200. This was nice and easy. And then your second one would be your commissions, accrued commissions revenue. And that is 1,350. Very nice and easy. So you have your 2 current assets. You move on to bank and cash. So you check, is there any bank, or cash at bank is what they're referring to it as here now. And you would see that your cash at bank there, 29,028. So you plug it in there. And the last or the least or the most liquid, least permanent of all of your assets would be cash, most liquid. Is there any cash at hand? No cash in hand. So therefore, total your current assets and you get a total of 44,518. So then you move on to your current liabilities. You check for your current liabilities, no bank loan below a year, but there is accounts payable, creditors, 5,866 using the first column. And then we have our accrued expenses or prepaid revenue, which we have 4 of when we did our little notes to the notes, the additional information. So we could always start in the order. And the first one we're going to do would be number 3, which would be your rent earned. So you ended up with prepaid rent received or prepaid rent revenue. And because we had been given the amount earned instead of the accrual or prepayment, we had to actually work out, and we worked it out that it was a prepayment. And how much was the prepayment? The 3,600 minus the 2,400, which gives you 1,200. So once again, it's always a very, very good idea to put your working so that we can know if you went wrong or that you understand and stuff like that, right? So the next one would be number 5, advertising owing, and that is accrued advertising, and they gave us the amount, which is 200. So you move to the next one, which is number 6. We have an accrued telephone expense, and once again they had given us the incurred, so we have to do working there, and the accrued amount is the 123 minus the 72, and that gives you 51. So that is the amount still owing. It's a current liability. And our last one, which is number 7, accrued wages, and they gave us the amount of the accrual, which is 1,000, so we just put it in there. So that is all of our current liabilities. So we would just tally, and it goes over into the middle column to be taken away or subtracted from your current assets, because your current assets less your current liabilities give you your working capital, which is what they usually like to see in a classified balance sheet. It's very important that you get that one very, very well understood and practiced and stuff. Current assets less current liabilities equals your working capital. So the 44,518 minus your 8,317 gives you your working capital of 36,201. And then you have your two figures in the last column, which will be the total non-current assets. So you have the 106,500 and the working capital. Once again, it's a positive figure, so you're going to add those two figures and you're going to get your first total of 142,701. And that is your first total, and you've just completed the most challenging or the longest part of your balance sheet. So you now can go on to the easy part of your balance sheet, having already dealt with your accruals and prepayments and your current assets and your current liabilities. Most of the work done, home run, towards the finish line now. So you're going to deal with the financed by. You only have 3 items there left if you check your balance sheet, your trial balance. You start with your opening capital, which you always find in your trial balance. So it's 60,000. Add your net profit. Where do you get your net profit from? We worked it out in our income statement, and we had worked it out as the 43,301. So that is the amount that is going to go into your balance sheet, 43,301. So you add that to your opening capital and you get 103,301. And then you less drawings. So you check to see, are there any drawings? In this case, we have a $600 in terms of drawings. So you less that, brackets to signify that you're going to less it. And you will have your closing capital of 102,701. So after you've done that, you have only one more thing to deal with. That is your non-current liabilities. And we have one non-current liability, which is your mortgage. And that's 40,000. It will just go in the last column since it's the only thing. So now you're just going to add your closing capital with your non-current liability, which is mortgage. And you get your second total, which is 142,701. And look at that. You compare your two totals, and once they are equal, it means that your balance sheet has balanced. Here we have our answer, and you would see that we have our totals are equal, and we should be feeling very, 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 very happy. And so if you would notice, for your balance sheet, most of the work is done here for accruals and prepayments. The second part is extremely easy. So once you have finished this, you can breathe easier. So this is what your answer sheets should look like with your templates or your answer sheets, where you have it flowing one after the other. And once again, once you just break everything up into sections, you can feel easier in terms of you can do it. Even though it may seem like a lot of work, it is once you have a nice little process going on, and once you practice. Once you practice, everything will become easier in time. Okay? That's it for this lesson. Remember, practice. Once you practice, it will become easier to do these final accounts with the adjustments. We have just done the first adjustment, accruals and prepayments. 2 more to go. But once you keep on practicing, you are building a foundation, and it will be easier and easier in the future. Till next lesson.